Hello, everyone.
Hi, everyone. We were muted there for a second.
Yeah. Hope everyone's having a great night. We've got a fun topic. We're going to talk about Sam and Sally tonight. That's going to be a lot of fun.
Yeah, we made some new friends this week. We've been hanging out with them. They have found themselves on the top of the Palmer Building here in Rochester, so that's pretty fun. I hope they have coats on because
It's chilly out there.
It's very cold.
It was really beautiful this last week, and then all of a sudden it got cold.
It was so beautiful. I was trying to chip the ice off of our driveway, and I would come home every night and I'm chipping the ice off the driveway, and Nick's go to bed. What are you doing? I'm I hate the ice. Anything I can do to get rid of the ice because more snow's coming. And then today it's 20 and super windy, and
it's a good workout.
It is a good workout. Your shoulders get all warm feeling, and yeah.
I think we have a fun way to talk about passive investing 101. And we spend a lot of time, like we just did our thing on commercial lending, and we talk a lot about kind of active investing techniques, but I think it's really important for us to talk about some really critical passive investing concepts.
Yeah. Can everyone see the screen? We're doing our screen share there.
Off to a good start here.
Okay, awesome.
All right.
Okay, a couple of announcements real quick. A lot of people are asking about K1s. So the deadline for K1s is March 15th. We're working as quickly as we can to get those out. I have every reason to believe that all of our K1s for all of our joint ventures and for Fund 1 will be out by that deadline. You will get an email to the email address that you used when you signed up for Invest Next, and it will come from a secure portal to download your K1. Fund 2, I'm hoping for March 15th, but realistically, I'm planning for April 1st. And the reason for that is we had so many acquisitions in 2022 in Fund 2 that we have all of those cost sags that we're waiting for. So March 15th is looking very good for the JVs and Fund 1 for the K1s. Realistically, probably more like April 1st for Fund 2, but we're going to get them out as quickly as we can. Lots of people are asking about Fund 3 already. So our first priority is, to appropriately deploy and steward the capital in Fund 2, and then even the capital that we have in Fund 1 from the refi of our single family home portfolio. But we anticipate that Fund 3 might open sometime this summer. If you'd like to put yourself on the wait list so that you can be the first to get all of the updates, you can do that at blackswanfund3.com. And then today we set the first half of the year of all of our community hours. So we have those there. And if you are subscribed to our calendar, those will automatically be added to your calendar. But in the event that you're not subscribed to our calendar, part 2 of tonight is March 13th at 7:30 p.m. That really crystallizes the story. Tonight we're talking about an overview of passive investing. And next month, we're really diving deep specifically into real estate passive investing. April 10th, May 15th, June, we're going to take a summer break. Nick and I will be crossing the country in June. We have 2 speaking engagements, one at Multifamily Investor Nation Conference in Charlotte on the first half of the week. Rachel and Kimberly will put the dates there. It's June 12th, 13th, 14th, something like that. And then we cross the country over to Phoenix, and we're speaking at Limitless Conference. So that's enough speaking and enough air travel for us.
And what are we going to be talking about?
What are we going to be talking about?
We're going to be talking, it's Valentine's Day, right? So
Valentine's Day was yesterday.
Well, you can't see it, but we decorated Elaine's office with all sorts of Valentine's decorations and stuff here.
It was pretty sweet.
I had to take down.
I had to take most of it
down so they weren't ridiculous. Yeah, they're kind of in the way of the camera here. In any case, we're going to be speaking on working with your spouse, investing with your spouse, and polarity and how to lean into your partner. One of the number one questions that we get from our investors is, how do I convince my spouse to let me invest in real estate, which I'm sure you'd agree is not the best premise. We have to work on that premise before we can really help someone answer that question. So just speaking to that question, how you can make your relationship better and ultimately have a bigger portfolio as a result of leaning into your partner. So
absolutely, so that's what we're doing in June, and then July 10th, and all of our community hours for the first half of the year will be at this time, which is 7:30 p.m. Central, and then we'll convert those to your time zone in our emails.
Seems like this has been our winner for the best time slot.
Yeah, I think
Good
so.
For East Coast and West Coast.
I think so. All right, let's get started.
Yeah.
So tonight we are covering Passive Investing 101, an overview of passive investing and how passive investing can be used to grow and steward your wealth.
So before we go any further, we need to say that we're gonna, potentially say some things here, share some opinions or things that we would do or things that we do ourselves in terms of past investing. We are not attorneys or accountants or certified financial planners, and so nothing you're about to hear today constitutes financial advice. You should consult your own licensed professionals and make your own decisions, do your own due diligence. So just a big old disclaimer there for you.
A little bit about us. We're Nick and Dr. Elaine Stoggerberg. That's us and 3 of our beautiful children. Our 4th baby was still in my tummy at that time. Just love that picture. We've been married for 11 years. We have 4 beautiful children. We live in Rochester, Minnesota. We are vertically integrated. We have an asset management company and a property management company. We have about $1/3 billion in assets under management, a little over 1,000 doors. We are now the largest housing provider in southeastern Minnesota. So very excited about crossing that milestone and all of the things that it means in terms of what we're able to do in our community and the change we're able to make happen here. We've raised about $60 million in capital over the last several years through our joint ventures, now our private equity funds. Black Swan Fund 3.com is the waitlist for Fund 3. And then we also have a real estate sales team, about 75 million in sales in 2021, another 75 to about 100 million in sales in 2022. And that puts us among the top 1% of all real estate agents at Keller Williams, which allows us access to Gary Keller's personal mastermind, a great place where we've learned a ton, had a lot of opportunity to just really learn from one of the best in real estate. And then we're also developers. So we have a $40 million ground up construction project that we're working on. We've been working on that for several years now. We will finish late this year or early next year. And then Nick spends most of his time these days doing development and new construction to look for our next projects.
Yeah, just a little bit of us. We're very vertically integrated there. We do our own in-house renovations. We have about 55 job sites going right this second. We do our own kind of in-house development. We are our own developer. We have our own property management company, our own real estate sales team. So we really lean into the vertical integration component of our business, and we think it's the thing that sets us apart. I'm really excited about this. Next year, we're bringing snow clearance in-house. So we're going to spend about $150,000 on the best equipment money can buy. I think it's going to reduce the cost of snow clearance to our assets by about 50%. Now, you have to have a lot of assets before you can go buy a plow, and we're going to get a riding power broom. It's like a car that's the width of a sidewalk, heated cab, and has a roller brush so powerful you don't even need to salt the sidewalk. So sorry, I get really excited about this kind of stuff. But these are the vertical integration components that we really love. That if you can save 50% of cost to your asset in snow removal, like those things add up very quickly at a 5 cap. So we love our vertical integration components.
Absolutely. If you'd like to connect with us, meetblackswan.com gets you to our page for our Facebook group, our newsletter. We're going to have a passive investing masterclass free guide up there very soon in about the next couple of weeks. So keep an eye out for that. Sign up for our fund, just all sorts of ways to contact us. Our calendars are also on there if you'd like to schedule a time to chat with one of us one-on-one to talk about investing, ways that we could help you.
I did 3 calls today, so I never
it's one of our favorite things to do.
Yeah.
And now, drum roll, we should have had a little, there you go.
Okay.
Thank you.
Yeah.
Thank you. I love it.
Happy to help.
Yeah. Sam and Sally. So this is Sophisticated Sam and Simple Sally, and they are our new best friends. They're going to have a ton of fun teaching you about themselves tonight and in March, and showing you the different ways that they invest and the outcomes of that.
You're gonna go on an investment journey with them tonight.
So Sam and Sally are mid-career professionals. Pick any profession that you've had to work a lot of time to get into that profession, whether that's medicine, law, accountancy, building a business, whatever that is. And they've hit that point that I think many of us have felt of, feeling like we've worked so hard to get somewhere. We've kind of checked off all of these milestones, jumped all of these hoops, trying to build, a life around that, maybe get married, settle into a home, have children, whatever that is. And then you kind of look around and you think like, is this it? Is this what I worked so hard for? There's lack of free time, taxes are crazy. When I look at, if I put a certain amount into my 401k for any number of years, retirement seems impossibly far away, especially if you're working different shifts, you're working overnight, maybe picking up call. There's just this sense of dread that comes and kind of looking around of, this isn't what I thought was going to happen as I worked so hard for this outcome. I think Sam and Sally feel that. Many of us, on the call are feeling that now or have felt that in the past. And one of the major ways out of that is financial freedom. We all know that financial freedom gives real tangible outcomes in terms of maybe being able to turn down a call shift or cut back at work or take that extra vacation or have that freedom to maybe take care of an aging parent, whatever those things are. But there's also a lot of psychological benefit that comes from financial freedom. And certainly the thing that we have seen over and over is I feel like there's like a sweet spot when someone is maybe 20% financially free, like enough that they can see it in their bank account, they can see it on their balance sheet, but they don't have to get to that 100% financially free. But around there, they just start to feel different. And they'll call and they'll say, I was really hoping, I'm planning for say 10,000 per month in passive income. And right now I'm around maybe 2,000 or 2,500. And I just feel totally different. I'm still laser focused on that 10,000 per month. And I know I'm going to get there and here are the steps I'm going to take, but I just feel different. I just have this confidence about me. And that's what Sam and Sally want. And so Sam and Sally have decided to start some passive investing and in the hopes that they reach those financial freedom targets that get them out of this feeling of burnout and pain. And more importantly, get them out of this feeling of being trapped.
Yeah, most people tend to feel this feeling around the age of 42. That's the magic number that we've observed just talking to investors. Maybe you're a little bit before that age, maybe you're a little bit after that age, and you're going to see, Sam and Sally take very different paths to try to address that feeling and see if you identify more with Sam or identify with Sally on their journey here.
So why is this so important?
So nearly all investments that most people make are ultimately passive. And then we, I would bookend that with saying that there's no such thing as a 100% passive investment. Even if you, invest in U.S. Treasuries or kind of put your money in the stock market and set it and forget it, you still, have to, check on that. I'd recommend just kind of checking on things maybe once a quarter somewhere in that territory. And you need to place that capital. You need to divest that capital when the time is right. So nothing is completely passive. And even when you're investing actively, I think the goal of most active investors is to try to be as passive as possible. And yet, I think some people they set out to be an active investor, and they almost try to make it harder than it needs to be. They try to be more involved than they need to be in the name of being an active investor. And the fact of the matter is, most people, at least in our experience, they're probably better off investing passively and then using that time that they save to focus on the things they truly excel at or the things that they just love doing. A watched kettle never boils. So if you're day trading stocks, this is just a statistical truth. You're very unhappy with the performance of your stock portfolio, regardless of its actual performance, and your performance is almost always lower than if you just set it and forget it in the stock market. And I think that's the case with most active investment categories. So it's very important to just understand the different ways you can passively invest and some of the mindset that's behind some of the most successful passive investors in history. And then you might ask, hey, you're the real estate people. Why are you about to talk to us about different ways to invest in stocks and bonds and precious metals and that sort of thing? You probably shouldn't have all your money in real estate, right? You should probably have some amount of diversification. Warren Buffett says the best way to grow wealth is to concentrate it. The best way to protect wealth is to diversify it. So depending on how close you are to financial freedom, what age you are, that might have a big impact on how much you diversify versus concentrate. Elaine and I are very much in real estate cash, and we have some technology money in a private equity fund at this time. But you should probably have some of your money diversified. And we're going to talk about two kind of interesting principles next year there, that just why this is so critically important. So the first is compounding interest. And you've probably heard one of these games before. If we were to say, okay, we're gonna play golf.
Oh, we should have done that before we showed the slide. That would have been so fun for people that haven't seen it before.
You like to rewind the.
Yeah, I have this like move when like the kids do something they're not supposed to or say something they're not supposed to or whatever. I have this rule in life that like it's all a video game anyway, so you can just like rewind the tape and just go back in history. But we've already showed the slide.
Okay, so let's say we didn't show the slide, and hey, would you like to play a game of golf? And we'll play just for a dime a hole, and we'll double it each hole that we play. You want to do that?
Yeah, I mean, that it sounds like it's like not even worth it, like a dime.
Yeah.
Like,
Well, that's no big deal. We'll just
sure,
play and see where it goes.
yeah, let's head out.
And this is the power of compounding interest here. Hole one, you're playing for a dime. Hole two, less than a quarter. Hole three, 40 cents. Hole four, 80 cents. So we're on hole five, and we're at $1 a hole. It's just not that interesting. And hole seven, we're at $6 a hole. Hole nine, we're at $25 a hole. We're halfway done with our game of golf, and we're still only at $25 a hole. And then we go up to 50, 100, 200, 400, 800, and eventually our game is worth about $13,000 with that last hole adding up to as much as every other hole before it. And this is the power of compounding interest. So it starts slow, but it's an exponential growth curve. And we find that this is a critical thing that most people don't understand. They'll get into an investment and they watch it for a few weeks, months, maybe a year or two, and it seems frustrating to them because they don't see how compounding interest works in the long run. And that's one reason why, as you get a little bit older, when you get to be 45, 48, you start to see some of this compounding interest really take hold. And I would say our investors get a little more patient when they get a little bit older because they've started to see, they get the glimpse of that compounding interest. But early in your investing career, it seems like it's not going anywhere.
Yeah, many of you have likely seen, a trajectory like the hockey stick curve. That's certainly the curve that our real estate wealth followed. Many people, in this room, if you haven't, seen it, just look for it. It's a pattern that happens time and time again, where you're kind of trudging along and it looks like nothing is happening. You're in, say, that hole 1 through, I don't know, 7 or 8 or even hole 9, but things are happening, and then all of a sudden it takes off. And there's that period right before the takeoff. That's, I think, where people feel the most burnt out because they've been at it for a while. They've been, in training, getting their education, delaying gratification, putting off vacations and all sorts of things, missing family events. And like, when is it coming? When is it coming? And then once it takes off, then it becomes this train that's impossible to stop almost.
Yeah. So that's the compounding effect. So let's check in with Sam and Sally and see how they're doing after getting a little bit of the way in their passive investing growth journey here. So Sam, he's always frustrated. He's sophisticated Sam. He's a very sharp guy, and so he's always looking for kind of that next big thing. And he'll invest in something for a little while, and then it just doesn't seem like it's going anywhere. So he'll sell that, invest in the next thing, and sell that, invest in the next thing. You probably have a couple people in your life, that they're always talking to you over lunch or at a group where you get together about their latest.
Or at that golf game.
At that golf game, yeah. While you're playing double or nothing for your holes. And each step of the way, he's paying some transaction fees. There's times when that capital isn't deployed, it's maybe not earning yield. And Sally, she understands how compounding interest works. So she sets it and forgets it. And maybe it doesn't seem as sophisticated, but all the studies show, all the stats prove that if you just kind of park your money in an investment that does well and you wait and you let that compound, you almost always outperform the day trader persona. That's just how the numbers shake out.
So that's our first glimpse into the psychological underpinnings of Sam and Sally. And now the Dunning-Kruger effect. This is Nick's absolute favorite thing. So I'll let you take it away.
Let's this one back. Okay. So if you were to chart a person's proficiency at something on the x-axis of a chart, and on the y-axis plot their perception of how proficient they are at something, what do you think that line would look like? So kind of like compounding interest, most people think of investment growth over time as being like this linear kind of upward curve, but it's not. It's like an exponential curve. And most people, when they think about how good they are at something and their perception of how good they are at something, you think it would be like a linear curve, a linear, just a straight line. So yeah, if I don't know much about something and I'm not very good at it, I'll know I'm not very good at it. And if I learn a little bit more, I'll get a little better. I'll learn a little bit more, and I'll get a little bit better. It turns out nothing could be further from the truth. This is a well-studied phenomenon, and this could change your life if you really lean into understanding the Dunning-Kruger effect. So it turns out that your perception, your self-awareness of your competence in any area of life, it's at its absolute peak when you know the least, when you know just a little bit more than nothing. This is kind of the genesis of beginner's luck, because you have so much confidence. Like I just learned to ski a couple weeks ago. and I went down. I went down the trail that like my trainer that I was with for the day said, don't go down that trail. It's like the famous trail on the mountain that they're famous for, but a lot of people get hurt on it, and beginners shouldn't go on down there. And I'm like, I know how to ski now. I'm going down the trail. I was at the peak of, literally physically at the peak of Mount Stupid in that moment. And then once you learn what you don't know, once you know what you don't know, that's when your perception is at its lowest, which is ironic because you now know way more than you when you were at the peak of Mount. Why are you laughing so much?
I'm laughing because so we're going skiing together in like a week, and I've never been skiing either. And Nick took a video of himself going down this mountain. And he's
that
like,
looked like the peak of Mount Stupid, that video.
And he sent it to me, and he's like, I'm going to teach you how to ski next week, and I want you to watch this video. It will give you a lot of confidence. And you know, I've learned, and I'm going to teach you. And he's going down the mountain, and it's a 20-minute video. And about
it shouldn't take 20 minutes to go down that mountain.
Every 45 seconds, he's falling. His skis are falling off.
They're like flying
people are coming to help him
put his skis
back on. And then the few times that he's doing really well, he's literally like shouting to himself, like, I can do it. It's okay. I'm brave. And I'm like, nothing about this video is compelling. Nothing about this video makes me want to go skiing with you.
So we're gonna say I had advanced to the valley of despair then in that video.
Clearly.
Clearly. That's progress right there. So people get stuck on this Dunning-Kruger spectrum all the time, and people lose their life savings at the peak of Mount Stupid. I'm gonna say that a second time. People lose their life savings at the peak of Mount Stupid. When you've taken a course or read a few blog posts or some forum posts, and you feel like you know so much about that thing, and yet it's a deep knowledge that you don't even yet know what you don't know. That's when you need to be really careful, and you can't go all in, or you could really lose it all. And it's only after you really start to figure out what you don't know that you become a safe investor, because by realizing what you don't know, you're not gonna go all in, and you're gonna be really apt to find coaches and advisors and defer to their advice. Whereas when you're at the peak of Mount Stupid, you might say, to heck with these people, I'm gonna do this myself.
I'm gonna ski down the hill that my instructor tells me not to.
I think I started at the peak of Mount Stupid at the top of the mountain, and I was in the valley of despair when I got to the bottom of the mountain.
I think so.
There we go. Little graphic of me on skis skiing down Mount Stupid.
Absolutely. This is super important. And we've seen it time and time again. We've seen people go through this, and you know, when they're at the peak of Mount Stupid, they feel confident, they're making decisions, making, you know, big mistakes. But then the valley of despair, people don't like that either, right? It never feels good to feel bad. But that's actually, like, we've trained ourselves when we feel the valley of despair with something that we're doing new. We're like, oh, we're getting there. Like, this means that we know what we don't know. We have some sense about us. We have some wits about us. And then, you know, that slope of enlightenment, I think the real ticket is getting to the valley of despair as quickly as possible, and then, you know, making that slope, you know, as high as possible. Obviously, if it's a little bunny hill, it's going to take a long time to get competence. But if you can train yourself to go through that learning curve very quickly, then you can get to high competence and high confidence at the same time. And you know, that's certainly what we try to do with the education and everything that we put out, is to get people through that learning curve as quickly as possible.
Yep. So let's check in with Sam and Sally now that we've covered what's probably the most critical, you know, two concepts in this whole time we're going to spend together. So Sam, again, he's very sophisticated. So he went and he took a course on tax lien investing, and these things, you're just printing money with these tax liens. So he spends hundreds of hours, a crazy amount of time learning about tax liens. So he's now right at the peak of Mount Stupid, and he's going to the tax lien auction, bidding against people who've been bidding on tax liens for 40 years. I don't know if you've ever been to one of these tax lien auctions, but the average person there's about 80 years old. They probably remember the last two times this exact property went to tax lien auction before, and one buddy bought it last time, the other buddy bought it another time. It's a deep knowledge set. But Sam, he's taken that course. He's done his online research. So he knows he's going to go all in on this thing. Until that is, he takes this course on NFTs, and he divests his investments in tax liens, and he goes all in on NFTs. Again, probably paying some transaction costs, and never never getting over the peak of Mount Stupid. Like he feels himself slipping into the valley of despair. He's like, oh, I'm gonna go find something else where I feel more confident in my skill. I loved that feeling at the peak of Mount Stupid. I want to get that feeling back. I'm gonna switch from new thing to new thing to new thing to try to keep that high. Sally, on the other hand, it turns out Sally is a skilled professional who's been trained for many years in her profession, practiced her profession for many years. So this actually makes intuitive sense to her because she's seen young professionals in her industry that have way too much confidence and don't really know what they're doing. And this is very intuitive to her. So she understands that if she just continues to focus on her career and goes from that slope of enlightenment to guru status, she's probably actually going to become extraordinarily successful in her career. And then if she does passive investing with other people who have done something for a long time and they're really good at it, she's probably going to be extremely successful at passive investing with those people.
So that is Sam and Sally on the Dunning-Kruger curve.
Mm-hmm.
All right, let's do some definitions. I really want to encourage everyone to stick with us, take notes, handwrite them, type them out, whatever it takes. Some of this is a little dry, but it's really important. From doing hundreds of investor calls, we find that people maybe don't know the basic definitions, or they think they know them, but they have them a little mixed up. And we're going to do our very best to simplify them, give you the definition, the formula, and an example so that you can see them. And then we're working toward talking about IRR. And those of you that have been around know that we don't like the metric IRR. We don't find it to be a useful metric, and we're going to build to hopefully providing you an intuitive understanding of why that is.
We're only going to talk about 8 definitions. So we think these are like
the things.
The things that we really cultivated of the shortest list we possibly could. If you can just get a grasp on these 8 concepts, you will understand every bit of lingo you possibly need to understand in investing and how to really underwrite any kind of passive investment.
All right. The first one is super simple: asset. An asset is something you own that has value. So an example is you own a house, or you own a collectible piece of art, or you own a stock market account, something that has value. Robert Kiyosaki takes it a step further and says that an asset is something that produces cash flow for you. I think that makes some sense in the sense that what he's trying to say is that people's personal home is not necessarily an asset. Nick and I actually sort of disagree with that, because we see time and time again that people will save a little bit for retirement in the stock market, but most of their family's wealth comes from owning their personal home. About
70% for the average American.
Yeah. That personal home doesn't generate cash flow along the way. And depending on what someone does in terms of acquiring it, if they acquire a home that makes them house poor, then that might be a challenge for them through their working years. But we really think of an asset as something you own that has value. And then just know that Robert Kiyosaki takes it a step further and says that an asset is something you have that something you own that has value and generates cash flow.
Well, is it Robert Kiyosaki who says that,
or is it Keith Cunningham,
or is it the woman who wrote Rich Dad Poor Dad that Elaine is fast friends with all of a sudden?
Yeah, I had the opportunity to meet Sharon Lechter, a really wonderful woman in the real estate space. A couple of people that were there with me in GoBundance are here on this call. Just a really wonderful woman. I encourage all of you to Google her real quick. Sharon Lechter. She really brought to market Rich Dad Poor Dad's legacy, and then also Think and Grow Rich's legacy. Like, without her, I don't know if those wonderful concepts would be in the hands of all of us. And just a really wonderful woman.
So that's an asset.
Investment is next. So the definition of an investment is committing capital to acquire an asset with the expectation of making a profit. Very simple. So committing capital to acquire an asset without the expectation of making a profit is not an investment. Say, like a boat that your family is going to enjoy, but you have no expectation that you're renting it out or making any sort of cash flow. You believe that when you sell it in 5 or 10 years, you're going to sell it for less than you paid for it, but you're okay with that because it's providing you with a lifestyle benefit. That's not an investment. An investment is specifically that you have a behavioral choice. You believe you're committing that capital so that you can make a profit. An example is you buy an investment property with a plan to rent it out to generate income.
Yep.
It's that simple.
Feel free to throw questions in the chat as we're going through. We've got some simple concepts. We're going to get to some somewhat more complex concepts, but if you have questions, anything, throw it in the chat. We'll do our best to answer as we go or answer it at the end. So next, let's talk about return. So this is your profit from an investment. Let's say you buy a house for $100,000, later sell it for $200,000, and you generate $100,000 of profit. your return is $100,000. Your profit is $100,000. And this is going to sound strange, but people often mix up these concepts. So like the concept of an asset and an investment, people mix those concepts up. They'll say something like, oh, I have an investment. I have a house. No. You have an asset that's a house. You have an investment where you deployed capital to purchase that house. And the goal of investing, by the way, is to have as many assets as possible with as little investment as possible. I'm going to say that a second time. Your goal, the whole goal of investing, is to have as many assets as possible with as little investment as possible. But most people don't necessarily understand the difference between an asset and an investment. And I feel like at Black Swan's model, it really boils down to this simple concept. Our goal is to go out and acquire as many assets as possible. We look at AUM as kind of one of our core metrics we look at, and how many assets we're able to acquire inside of each private equity fund that we have, or each joint venture partnership that we have. These are really critical concepts to understand, and then to understand that the whole point of investing is to get as many assets as possible for as little investment as possible. And then ultimately, the more assets you have, the more return you're going to generate. Next, let's talk about rate of return. Rate of returns. This is another concept.
I returned.
You did return.
I returned with water.
Wow, that was like right on cue. Thank you. Yeah, I'm parched today.
Rate of return. So also called return on investment, or ROI. So our ROR and ROI are the same thing. We tried our best to include the alternate phrases that just various people use based on kind of how they were taught or different trends, so that you would know that there's fewer definitions than it seems like, because it's the same, different words are used for the same thing. So ROI is how much profit you make relative to the amount that you invested. So the formula is profit divided by investment amount. So if you acquire an investment property for $150,000, this must have been the Midwest in circa 2015.
There you go. Yeah.
And 2 years later, you sell it for $200,000. You have generated $50,000 of net profit. I heard Nick talking about the difference between profit and return. So your profit is $50,000. Your investment amount was $150,000. This is assuming no leverage. We tried to keep this just really simple. So 50 divided by 150 is your rate of return is 33%. How are we doing? Making sense?
That makes sense.
Good.
So far?
We're halfway through our definitions.
Yep.
All right. Cash on cash rate of return. This is the one everybody wants to talk about.
Yep. So now we're going to look at annualizing our return. So we're going to look at how much return we get per year. So we're getting close to some of the kind of critical metrics that people look at to evaluate any investment, which is cash on cash rate of return, average annual return, and internal rate of return. So basically, this is the amount of cash that you receive from an asset each year, based relative to how much you invested in that asset. And again, the investment is the amount of capital you deploy to get the asset. And that's a different concept from the asset itself. So we're just going to divide our annual cash received by our investment amount. So an example of this here, we buy an investment property for $100,000. This is Midwest circa 2010. And
we're going back in time.
Well, that's not true. We bought a house for $35,000 in 2013 or something like that.
That's
but
true.
that would need a little bit of work. That was a fun one. Okay, so you buy an investment property for $100,000, and each year it produces $10,000 of cash flow. Your cash on cash rate of return is 10%. So you get 1/10 of your investment amount every single year. You have a cash on cash rate of return of 10%. And people get really, really hung up on cash rate of return and this magic number of 10%. That was a great number to shoot for in the real estate world back in circa 2018, 2019, somewhere in that territory. That's a hard thing to hit these days. And it's an easy stat to manipulate, because you can magically make your cash on cash rate of return go up on any investment by just getting lower quality debt, by getting lower LTV debt. So you have less debt on the asset. But at the end of the day, that's going to lower your average annual return, which is the next concept we're going to talk about, and is much more important than your cash on cash rate of return.
In our perception, when we're developing our investment decisions, this is the most important metric.
Yes, this is the metric. This is the metric that we are solving towards. Is average annual return. This can be called total annualized rate of return or annualized rate of return. There's a few different synonyms out there, but it's basically on average, what is the total return per year that you might get from this asset. So you divide your rate of return, total rate of return, by the number of years in the investment. So let's you buy that investment property for 150K, and 2 years later you sell it for 200, generating 50K in profit. Your annualized rate of return is 33% divided by 2. So that's the example from before where we calculated your rate of return. We have to divide that by 2 years. So our average annual return, or our annualized rate of return, is 16.5%. 33% divided by 2. Okay. Any questions about that? Any questions about average annual return? This is the most important metric that we solve for in our underwriting.
When you hear something like, say, the stock market produces an average yield of, say, 7 to 9% over the last 75 years, that 7% is this number.
Yield is another word for average annual return.
Any questions? You guys are quiet tonight, which either means this is really boring.
Y'all are experts.
Or you're experts.
Yeah.
Or we're amazing teachers.
We haven't brought out Sam and Sally lately.
Or
so.
they're missing Sam and Sally.
That's right.
They're
just a few slides away.
Any questions? Any feedback? Good, understanding it, making sense. How do you calculate that if you don't sell in 2 years?
Great question.
Yeah, great question. So you wouldn't have a sale, but you could calculate your equity, return on equity. So if you had very good reason to believe that if you sold that property, you would be able to sell it for $200,000, then that's what you would put into your calculator. Very good question.
Yep.
Do we look at sequence of returns?
I'll be honest, I'm not familiar with that term. What is sequence of returns, Chandra?
I suspect that is kind of like a sensitivity analysis or something like that, but
we'll see.
That's not something we do, or we just don't know the exact name of it. Yeah. Any other questions? All right, then let's go to IRR, everyone's favorite thing to talk about. So here, if you have a chance, if you're not looking at your phone or your screen, now is the time to look at it so that you can see the formula for IRR.
Yeah. So Chandra said, kind of when you get the returns versus total returns. That's something that IRR would account for essentially. So IRR is just a way to measure average annual return weighted for the time value of money. So if you get that return sooner in the investment, you have a higher IRR than if you were to get that return later in the investment. IRR, it's the most kind of universal way to compare all investments across different asset classes. The challenge with IRR, though, is that it's somewhat easy to manipulate in a projection. You can kind of pencil in different numbers into your projection, and that can tweak your IRR very quickly. And as you can see, it's a somewhat complex formula to compute your IRR. You typically have to do what's called a discounted cash flow analysis. A typical syndicator or finance person might do like a 5-year discounted cash flow analysis. That's the most common time frame. So you do 5 different iterations of this calculation here, where it's CF1, CF2, CF3. Those are different years of return, and you have to do a pretty complex or sophisticated calculation before you can get a result. And the result might be a little bit confusing. So if we go to the next screen here, we've got a few different scenarios that we put together.
Before we go to the next screen, the thing that I just want to add is I am very much a believer in keeping things really simple, just focusing on basics, good, high quality investments done with a long-term hold. And I can just intuitively look at IRR and know that this probably isn't the best metric because it's very complicated to understand. It uses a formula that's not intuitive to the human life cycle. The human life cycle is all about cash flow that we get to pay our bills today, and then wealth that we're generating so that we can have more cash flow in the future. And this formula doesn't quite get there. And so I think just intuitively, you can look at this compared to the other 7 formulas the other 7 definitions with the formulas that we presented, and know that this likely isn't the best metric. It's likely using some sort of sophisticated model to make it seem like it's the best metric, but it doesn't really match human needs and human psychology. That's my take on it as a psychiatrist.
Yeah. So here's a few examples. Again, if you have the ability to pull up your screen, this is there's a lot of visuals in our community hour this month. So we've got a few different investments here, and each of these investments returns the same amount. So you've got, you put in 100K and you get 200K back in investments A, B, C, and D. It's just a question of when. So this is just an illustration of the difference between average annual return and internal rate of return. So you can see an example A, you get it all at the end. In example D, you get it weighted towards the beginning of the investment. And that IRR stat is people, I think, don't even realize that IRR can actually be higher than average annual return. Like we've heard of multiple investors say that they don't like how people work with AAR because it's higher than IRR, as though it's like an inflated metric. No. IRR does not. That's not the correlation of IRR to ARR. It's purely just a time value of money calculation. So you can return the same amount, but end up with with figures ranging from 15% to 44% on IRR. So I'm gonna say that a second time. You get the same amount of money back. You just get them in different time frames, and your IRR ranges from 15 to 44%. Your AAR stays at that 20% average annual return. So I just think a human's able to kind of understand this concept a lot more easily. AAR is just a far more intuitive metric to understand. Again, if you're a sophisticated person, if you understand IRR is technically the most accurate way to compare different investments, and it's phenomenal to have a stat where scenario A and scenario D, you have a really clean-cut way to compare them very valuably. But for most people, it's very counterintuitive how it works. And then we have a scenario there for New 52 because we just hit our full cash out refi on New 52. So when I was putting the spreadsheet together, I said, man, we should just do a quick little forward projection on New 52, assuming because we hit a full cash out refi in about 16 months. So it's actually a little bit better than this. And that's going to keep paying out cash flow with cash out refis about once every 5 years or so, we'll say for the next 20 years. And we hit a 30 IRR and a 35% AAR. Now, if we had fewer years in the deal, then our IRR would have been way higher than our AAR. But we love an indefinite hold period. We love a long hold period. And this is a critical concept to understand. So IRR really punishes time. IRR really punishes time. And if you are in like the New 52 investment, you probably have to be a little crazy to get out, right? To say, okay, I'm going to take my money and put it in somewhere else. No, you've already gotten your money out, and it keeps cranking out cash flow and cash out refi proceeds for the indefinite future. But each year you stay in that deal, your IRR goes down. Each year you stay in the deal, that your IRR goes down. So this is just another way where I think IRR, it is technically the best metric to compare investments, but it can really convince you that you ought to sell that golden goose. If you have an investment that's doing really well, why would you ever sell it? It's just it doesn't make intuitive sense. So yeah, that's IRR.
I hope that these last couple of slides have been clarifying and understanding why annualized rate of return is our preferred metric. And then also in understanding why we don't really get hung up on a cash on cash rate of return, because our metric is payback period of how quickly can we get all of the capital out of a project. And the way to do that is to maximize the total annualized rate of return so that you can get to a 100% total rate of return as quickly as possible, get all the cash out, and then stay in the deal. So who really cares if a deal is 7% cash on cash in year one versus 10% if you're going to have all the cash out in just a few years anyway? So I hope that that's been helpful, kind of describing some really important, simple concepts that everyone should know to understand passive investing, and then also giving our flair of kind of how we interpret them, what metrics we think are important, what metrics we think are less important, and then most critically understanding IRR and why we don't think it's a very useful metric. And so when you see it kind of splashed all over deal decks and those sorts of things, be critically thinking, well, why is the IRR this way? And what is the annualized rate of return? Because that's really what's most important. That's really what drives your total net worth growth as quickly as possible.
Yep.
Let's talk about Sam and Sally.
Yeah. So Sam, again, he's sophisticated Sam. So he knows how to calculate IRR. He's probably a professional accountant or something like that. And he understands that the investment with the highest IRR is always the best. And from a purely technical perspective, that is 100% true. IRR is the gold standard for comparing assets, investments across asset classes. So he'll exit opportunities early to maximize this critical metric, to sell an asset while it's on its way up to try to maximize his exit sale price. Now he has to pay tax on realizing that profit. And then his capital isn't necessarily working between those deployments because he's exiting that deal that's doing well. He's exiting that deal early, and he has to go find another deal to invest in. And maybe it takes 6 months or even a year before he has a new place to put that capital to work. But he has a long string of big numbers he can enjoy thinking about. And Sam is a real person. He's a composite of a real person. people will call us and say, I've gotten a 32 IRR and a 34 IRR and a 37 IRR. What's your IRR? And I'll say, okay, well, what was your total yield on that? How much, what was your equity multiple? How much money did you really make? How long were you in that investment? He's like, well, we put in 75,000 and we exited with 93,000 in just 9 months. And I'm like, okay, so let me get this right. You made less than $25,000 on something you spent how many hours underwriting, getting in, getting out, paying transaction costs, paying, taxes. And now he's looking to place $93,000 in our fund. Meanwhile, Sally, she doesn't know what IRR is, but she does know that if an investment is
She knows
doing
it
well,
has the squiggle.
she knows it has a squiggle. That's right. Yeah. She knows that if an investment is doing well, it seems pretty silly to sell it. And Sally, again, is a real person. We have investors who call us all the time, and they're like, yeah, I got in this fund or I got in this syndication and it was doing really well. So I just kind of left my money in there. And I have about $1.3 million in that thing. It's coming to an end. So, could I put 1.3 million in your fund? The big investors, the people who have really had huge equity yields at big equity multiples, they've made large sums of money. They're almost always long-term hold people that just parked their money somewhere for a decade, that it did well. It was hitting a 10, 15% return, maybe not a 30% IRR, but a 15% AAR for 10 years. And they made a crazy amount of money doing no work whatsoever. These are the people that day after day we talk to that have the most amount of capital to place.
That's Sam and Sally.
That's Sam and Sally.
All right, let's talk about risk-adjusted return. This one's a little fun. Yeah, I really want for this one to be interactive in chat. There's no true right or wrong answer to this.
Oh, don't give it away.
This is just something I want to explore and understand together. And I think that, certainly when Nick and I went through this, we were talking about, well, I might do that one in this situation, or maybe, years ago I would have done that one. Right now I would do this one. In the future, I could see how I would do this one. There is a mathematically correct one to choose, but it really depends on who you are as a person, where you are in your life cycle, what you have going on, how much capital you have to work with. Obviously, the more capital you have, the riskier you can be in terms of kind of trying for those bigger and bigger wins. But I'd love to, I'm going to read these out, and I'd love to just see in the chat. Again, there's no right or wrong. I just kind of want to get a sense. You can just say, we should have numbered these, but 1, 2, 3, or 4. 1, 2, 3, or 4. Which one would you choose? Just drop that in the chat. And then if you want to, maybe say like, I would choose 2 and then put a dash with like a little blurb of why. So I'll read these out to you guys pretty slowly so you can think about them. Would you rather have choice 1, a 100% chance of a 5% rate of return and a 0% risk of total loss? That's choice 1.
Is your annualized rate of return, your AAR.
Choice 2, a 99% chance of a 10% rate of return and a 1% risk of total loss. Choice 3, a 90% chance of a 20% rate of return and a 10% risk of total loss. Or choice 4, a 75% chance of a 100% rate of return and a 25% risk of total loss. Would you rather have 1, 2, 3, or 4? I'm seeing some numbers coming in. I'd love to also see
what's your reason why?
What's your rationale for that? If anyone wants to, I can give permission for folks to unmute themselves and just kind of give us a sense of why you would choose the one. I'd love to open the floor here so we can just get to understand human behavior. Again, there's no real right or wrong answer.
We tried to carefully choose these numbers so it wasn't like an obvious choice one way or the other.
We have a 2, a 3, a 1, a 2, a 1.
I guess it depends on the way the risks were defined. Like the qualitative component of the risk.
Would anyone like to give us a defense of why they would choose choice 1? And even if it's not something you would personally choose, I'd love to get someone that they would personally choose that. But even if you could just put yourself into the mindset of why someone would choose choice 1. So that's a 100% chance of a 5% rate of return and a 0% risk of total loss.
That'd probably be the equivalent of like a treasury, which right now where you're getting 4.5%, almost 5% on a 4-week T-bill, which is historic. That's 100 times higher than it was a year ago. So if option one is appealing to you, that is a real investment opportunity there.
Anyone want to talk about choice one? You guys are so quiet tonight.
It's okay.
Oh, go ahead.
Nihal?
Hi, good to see you.
Oh no, I'm good. Sorry. Thank
Do
you.
you want to talk about choice one? Oh, he left. Well, good to see you. So choice one, a 100% chance, a 100% chance of a 5% rate of return and a 0% risk of total loss. I think of something like someone that's elderly, maybe someone who has been widowed, maybe someone who has a very fixed, stable income with little opportunity to really grow that income, but they need to have a steady rate of return to live off. That's what I think of when I think of choice one.
Yep, absolutely.
Okay. Choice two, a 99% chance of a 10% rate of return and a 1% risk of total loss. I think for something like that, a little bit more, so maybe it's someone who's maybe getting older, but maybe choice one, there's someone that's 75 years old and they never want to work again. And so they cannot lose the nest egg. Maybe choice two is someone that's 55 years old. So they don't want to lose it all, but that 1% chance, if they lost it all, like they could figure it out. They could get some more years in the workforce. They're skilled. They're likely high paid at that point.
They're going to be so much more comfortable with double that rate of return.
Exactly. Because they want to,
or to compound for a little while. Yeah.
Exactly. And they look at that 1% and they say, like, this is pretty unlikely for this to happen. A 90% chance of a 20% rate of return and a 10% risk of total loss. Again, when I kind of go that, I think of, a little bit of a younger person, someone that says, I don't want to lose it all, but if I did, I could find a way to remake it. I feel comfortable with that 10% chance. It's not so high that I worry about my investments every day, or I'm checking my accounts every day, but it's a little high. There's a little sense of it's certainly, it's 10 times higher than 1%. That's the point where I can kind of like, ooh, that sounds like that's like a decent chance. If you live, every decade, you would have a 1% chance of losing it all. Like a decade goes by pretty quickly. And then a 75% chance of a 100% rate of return and a 25% risk of total loss. To me, that sounds like money.
No one went with 4.
No one went with 4.
Wow.
You all are steady, stable,
steady
Sallies. So that to me sounds like someone who's younger. Maybe they're just starting out, they're fresh in their career, they have a lot of money. So maybe they are literally thinking about going to Vegas and having some fun. Or they're saying something like, I don't know much about Bitcoin, but I have some extra money. My other investments have done well. I'm going to take, a small portion of my overall wealth and see what happens. Or they have enough money set aside into more stable investments that maybe a friend is starting a business, or they want to put some money into venture capital or something like that. That's what I think about when I think of that 100% rate of return and a 25 risk of total loss. I also feel like that the psychology behind that could be a sense of desperation of someone who's nearing the end of their career, maybe hasn't saved what they're hoping for, and they feel like they have like kind of one last chance to kind of double their net worth, double their retirement savings. So that's kind of the opposite that I would see there. That is my perception as a psychiatrist, as someone that understands people. What's the mathematical stuff behind it?
So, I mean, each one you go, you make more money, right? There's a higher average annual return, so to speak, if you want to think about it with each scenario. It's just a question of risk tolerance. So not a single person can stomach the idea of losing everything, 1 out of 4 times. And that's a very normal human psychology. So there's a little bit of a trick question. No one said I'd put some into this bucket, some into this bucket, some into the next bucket. You can have a diverse asset allocation, or a diverse portfolio, different phrases that you might hear. And it might make sense for you to say, okay, I really need X number of dollars to be able to start over again. So let's say Elaine and I needed $1 million, and that's like our down to the felt number that we would need to, let's say somehow everything fell to pieces, not no indication that's going to happen, by the way, but if we had $1 million, we'd be able to start over again. We'd be able to start, Black Swan over again and take care of our family. So we're going to put $1 million in bucket number one.
Mhm.
Even though we have access to these really high yield investment opportunities, we're going to put in bucket number one. And that might be something like a whole life policy. That's kind of an expensive, low yield thing, but it's like a 0%, risk of loss. And it's even protected from bankruptcy, protected from creditors, protected from death. So that would be, kind of like a really rock solid place for number one. And then maybe you put a little bit number two and a little bit more number three and a little bit number four. Maybe you put kind of your minimum in number one, and then you just go all in on number four and say, okay, one out of 4 times I'm going to lose it all, but I've got a whole bunch of assets in bucket one that I'm never going to lose, so I can replenish what I'm putting into bucket number 4. So this is just, your asset allocation strategy. And then there is no right answer. This is something that's going to be unique to you. You just have to do it with eyes wide open. That's all. Yeah.
Absolutely. I hope that's been helpful, a little bit fun to think about. Even if you didn't share, I hope it got your own wheels turning, thinking about, your own lifestyle, your own risk tolerance, what's going on with, your age, people you need to take care of, those sorts of things. Hopefully that got your wheels turning there.
Yeah.
All right, let's talk about finding your unfair advantage. This is a concept we've just leaned more and more into over the last several years. When, a lot of people come to us asking for investment advice. And first of all, we don't give investment advice. We tell people, what we've done. We have a clear offering in our private equity fund of this is what we are doing. But something we can give in terms of life advice is find your unfair advantage in anything that you do. You should ask yourself, how can I excel more than an average person that's doing this thing? And certainly there's an opportunity to do that in investing as well. So your unfair advantage in investing can be things like location, industry, your professional training, your professional experience, capital, credit, and it's often a relationship. So I'm sure you can think through those things and understand, say, like we invest in technology because Nick spent over almost 2 decades in technology. So we have some unfair advantage there that we understand the lingo very quickly. We can look at a business plan and understand it in a way that we would not necessarily be able to in, say, aviation. Neither of us have had a career in aviation. Obviously, we have an unfair advantage in the 2 locations that we choose to invest in. So you can think through this list, and there's other ways to have an unfair advantage. These are just the ones that we see most often. And ask yourself, how can I use these things and leverage them to my advantage to have an unfair advantage so that I can excel in investing?
Yeah, and each of these things, it's going to be unique. It's going to be unique to you, but you just have to think, where do I have something that most people don't have that thing? Like we were just doing some coaching with an investor who lives in Nebraska, and he's investing in Kansas City because he heard you always want to invest out of state. And we're like, like you're in probably a better investment market in your backyard. But just there's a lot of popular advice out there that you always want to invest, from out of state. Elaine talked about industry, capital. We talk to people who have a lot of capital to deploy, like 10 or 100 or 1,000 times more capital than the average person. That gives you a huge investing advantage. What are things that you can invest in? Like if you're an accredited investor, you have to have at least $1 million net worth to be an accredited investor. Those opportunities are not accessible to people who are not accredited investors, and they almost by definition have a significantly higher rate of return because they're only available to a select group of people. If you have a really high credit score, you're eligible for credit that other people aren't eligible for. That was a big thesis of our commercial lending community power hour that we did last month. And one of the biggest unfair advantages you can have is a relationship. Do you know someone that's wealthy, that's successful, that a group of people, they don't have to be close friends, just who are the top, jot down right now, who are the 5 most successful people you know in your life? And just right now, shoot them a text and say, hey, I'd love to buy you coffee. And I would just love to ask you, like, why are you so successful? What are the things you credit? What moves did you make? What relationships have you had in your life that you attribute so much of your success to? And you will be blown away at how quickly you notice patterns in that. Like, I promise you, there will be 3 or 4 things that those 5 most successful people in your life they'll attribute. There'll be maybe even the same person that, oh yeah, I got into a relationship with this CFP or with this real estate agent or with this fund manager, and they made me a ton of money, more money than all of the other ways that I've made money combined. So everyone, you have an unfair advantage in your relationships. You just have to discover it.
All right, let's talk about Sam and Sally and their unfair advantage. So Sam takes many different courses on
He's
investing.
sophisticated, remember?
Sophisticated
So
Sam.
he's taken tons of courses.
On investing in real estate. He decides to remotely self-manage short-term rentals, buying one single-family home in 5 different markets so that he's diversified. However, his lack of concentration eliminates any advantage he could have had in just one individual market. So he doesn't quite know, on that street, the new grocery store is coming in, and over there's the new park, and this street over here isn't doing so hot because he's in 5 different markets and doesn't have a concentration of knowledge there. Sally, on the other hand, she's pretty simple. Sally asks the 10 most wealthy people she knows what they do with their money. She notices a pattern that most of them have invested in real estate with a particular agent. She asks them for a referral, and she follows their asks their step-by-step instructions on how to reproduce that success. And then most importantly, she follows that guidance precisely. She doesn't pick or choose the parts that she likes. She follows that recipe to a T. She leans into her unfair advantages of social connection, assessing people's character, and understanding the basics. That is Sam and Sally and their unfair advantage.
And Sally probably spends about 1/1000th the amount of time that Sam does to get probably better outcomes on the net.
Yeah, that's certainly something that, it can be quantified, but with Sam and Sally, we didn't quite do that, is the time adjusted return.
Yeah.
So it's likely that both Sam and Sally have many hobbies outside of investing. And the reason they want to invest is so that they can enjoy that free time and those hobbies. Sam might have convinced himself that he likes to learn about investing so that he can have kind of the thrill of the chase of, going through that Dunning-Kruger
Love the
curve
peak of Mount Stupid.
over and over and over, kind
That
of
peak
chasing.
is so thrilling.
Yeah, chasing these big numbers, chasing the ups and downs. But really, Sam probably wants to spend time with family, travel, all of those things. And Sally's just doing that.
Yeah.
So let's talk about asset classes.
Woo!
So what are some things that someone can invest in? Cash and cash equivalents, fixed income securities, that's something like bonds. Commodities, that's something like precious metals. Alternatives are things like crypto, cars, art, hedge funds. Technically, real estate is an alternative investment. We put it in its own bucket because it's such a large alternative investment, and it's often the only alternative investment that people have. Equities, so public equities is the stock market. Private equities is something like the Black Swan Technology Fund, any other syndications or private equity offerings that you've heard of. And then within real estate, there's direct asset ownership, joint ventures, syndications, private equity funds, and then REITs. And you can kind of think of a REIT as almost like a stock of real estate. That's kind of where those two worlds kind of start to overlap, that you're technically invested in real estate, but it functions more like a public equity. So those are all of the different asset classes that someone can invest in, and we'll dive in and explore each of them a little bit more.
Yeah. So you have to think of cash as defense, not offense. Cash doesn't generate a return. It's vulnerable to inflation. So if you put money under your mattress, it's not doing you any good. So at a minimum, you want to think really critically about your cash equivalents. So a treasury, for example, should be kind of good as cash. But if you have like a home equity line of credit, that would be a cash equivalent that's kind of less reliable. If that line of credit was frozen during a time of economic downturn, it may not necessarily be available when you need it. The whole point of business is to convert assets into revenue, to convert revenue into profit, and to convert profit into cash. I'll say the second time. The whole purpose of business or investing is to convert assets into revenue, revenue into profit, and profit into cash. And you get to keep playing the game so long as you have cash. So it does not matter how much equity you have or how much profit you have, how many assets you have. As long as you have cash, you get to stay in the game. So cash is beyond critical. We recommend keeping a pretty significant amount of cash on hand. We keep about a year's worth of cash on hand personally. Right now we mentioned T-bills there. Wouldn't mind keeping some money in T-bills right now. A good rule of thumb out there is to keep about half of your cash in actual cash in bank accounts or cash equivalents like T-bills, and about half in lines of credit. That's the most critical concept to understand, is that cash is your defense. It's not your offense.
So Sam keeps very little cash on hand so that he can maximize yield and constantly be chasing the next investment. Sally, on the other hand, keeps 1 year of cash and cash equivalents available at all times. It's a little more boring, a little more steady, but it really allows her to feel very comfortable that she has a big defensive metric around her.
Yep.
Fixed income assets. So these are things like bonds, whole life policies, a way to protect capital, but has, generally poor yield. A bond, might have, say, a 5% rate of return. So certainly, not what someone could get in public equities and certainly not in private equities, but a little bit more than cash. There's a crisis brewing in fixed income assets right now that's kind of beyond the scope of what we're able to cover tonight. But just kind of the way the markets are changing, just know that there's a crisis brewing in fixed income assets. Preferred equity is a strong option. So that's something like an offering that pays, say, a fixed 10% or a fixed 7%. There's all sorts of numbers out there, but it's a fixed number. And so you're maybe investing in real estate or technology, or you're backed by something, but as the investor, you have a fixed return instead of a variable return. Private lending is also a strong option. So you work with someone that's investing in, say, real estate, you give them capital, they pay you a fixed interest rate, and then they're off, using that capital to invest in real estate. Sam and Sally. So Sam has heard of infinite banking. He thinks it's what sophisticated people do, and he puts a lot of money into a whole life policy. He thinks bonds are kind of boring, so he invests in a leverage bond fund to get higher yield. So he's really chasing these kind of sophisticated concepts to, feel good about the investments that he's making, to feel like he has an unfair advantage. But really, he's just adding a lot of complexity to his investments and making it hard to see the real rates of return. Sally doesn't take a ton of risks, so she doesn't need to protect her assets in a whole life policy. Instead, she just gets a simple, inexpensive term life policy. She likes the certainty of fixed returns, and she uses the savings between what a whole life policy would cost and a term life policy would cost, and she uses that to invest in a preferred equity fund.
There's no right or wrong answer. Like, we're being awfully hard on Sam here, right? But for Sally, she's not a high risk person, so she doesn't need to have money socked away for a rainy day in that bucket. And for all these things, we're just kind of sharing with you our own opinions. For entertainment purposes, we'll say hopefully you find Sam and Sally entertaining anyway. Just know that for most people, it doesn't make as much sense to be sophisticated. These leveraged bond funds they're scary businesses. Interest rates go up, the value of bonds goes down, and many of these bond funds, in order to generate yield, they took out leverage, they took out loans against those bonds. And so the interest rate on those loans is going up now. I don't know if you remember a few months back, there was a day when like every retirement fund in the UK became insolvent, and the government had like bail out every single retirement fund. There's a big storm on the horizon with those leveraged bond funds. They're all of a sudden upside down. There's trillions of dollars in these bond funds in retirement accounts, pension funds. So the value of bonds is that you get this really stable, safe return from, say, Ford Motor Company or whoever you're getting the bond from. And when you join a bond fund, that's now a derivative, and you don't really know exactly what you're getting. You might get a little bit higher yield, but your risk profile goes up dramatically.
All right. We already did Sam and Sally there. Precious metals and commodities. So precious metals and commodities are a good diversity play. They're counter-cyclical to like the usual market. It's a hard asset that's indexed to inflation. So like gold is a hard asset, and as inflation drives up the value of hard assets, it drives up the value of gold. Real estate is a hard asset. So as inflation drives up the cost of bricks and 2x4s and sheetrock and all of the other things that go into that hard asset, it drives up the value of real estate.
We're all in on 2x4s.
Precious metals are, difficult to leverage, needs to be in your physical possession. So that can be, somewhat risky. This is something you might want to keep very secret so that you don't, have any concerns about your physical security. Bank lockboxes are a problem. I'll let Nick, kind of speak to that. And then ultimately they're very low yield. So it's a way to kind of store wealth, but not necessarily grow wealth.
Yeah. A lot of people, they like the idea of investing in commodities, but they don't actually buy the commodities. So that's kind of a problem. So it's like buying that bond fund versus having an actual bond. It becomes a derivative that now loses many of the intrinsic advantages of owning that commodity. So like I have some friends that have actual commodities. They have, head of cattle on their land, or they have physical precious metals in their possession. So these are people that have pure control over their commodities. I don't know if you're aware, but numerous times in U.S. history, possessing certain amounts of precious metals has been made illegal when there's been fluctuations in currency valuation. We're not really like doomsday preppers or anything like that, but keeping precious metals or commodities, but not in your possession, it gives you kind of the worst of both worlds of owning precious metals. So it's a fun way to diversify, especially if you have some kind of unfair advantage. My next door neighbor in Oklahoma, he would invest in oil, because he was an oil man. He was a landman out there knocking doors every single day. He knew what oil and gas mineral rights were worth, and he was able to buy them for like 50 cents on the dollar. So he was a huge investor in commodities because he had an unfair advantage in that commodity. But me, I should not be investing in oil and gas and mineral rights because I don't know a darn thing about it. So that's just some of our thoughts on some of those assets. Yeah.
So Sam sees that precious metals are way up and he wants to get in. Physically managing the coins seems like a big hassle, so he buys shares in a fund. After a year, he realizes there has been no yield from this investment and he sells it at a mild loss because it's not very interesting to him anymore. Sally has always thought that gold and silver coins are nice to have just in case. She buys some gold and silver eagle coins each year. About 1% of her net worth she has in these coins. She keeps them in a very safe place in her personal home. She enjoys taking them out. She enjoys looking at them from time to time. They're just a small store of her net worth. They don't produce yield. They're just something that she has just in case.
Yep.
Alternative asset classes. We're getting closer and closer to real estate.
Yeah. Lots of fun things we could talk about here, but basically, if you don't have an unfair advantage in one of these things, like if you, we would probably do okay investing in venture capital because, I had about 15, 20 years of experience in that space, in the tech space, but I've never done anything in a hedge fund before, so I don't think we would have any sort of unfair advantage in the hedge fund space. Maybe you are an art fiend and you know about art and collecting art or cars. Maybe you like some sort of esoteric, I know all sorts of, stamps or whatever. There's lots of things you can collect that have intrinsic value that tends to be persistent over time. And if you have fun doing it and you can, have an unfair advantage, lean into it. Alternative asset classes are a very fun way to do that. The most popular one these days is cryptocurrency. So we actually heated our home through a Minnesota winter in 2017, 2018 with cryptocurrency mining rigs. So we've done a little bit of cryptocurrency. Being a technology person, I like cryptocurrency. I think most technologists would agree that blockchain is one of the most important technological inventions that's really kind of happened since the internet. It's a crazy, amazing invention. The idea of knowledge that is kind of indestructible, a permanent ledger of knowledge that will never die. And cryptocurrency is built on that blockchain technology. It could one day be like the global currency. But again, any expert will tell you that 99.9999% of all the cryptocurrencies out there right now are going to zero in the next decade. Almost all of them are going to zero in the next decade. So it's a high risk bucket. So if you didn't like the 25% chance of a total loss, you probably don't like the 99.9999% chance of total loss. So it's a good bucket to put a little bit of fun money in. Probably not a good place to put a majority of your net worth. It's really fun and sexy, and you see it on the news very often. But the fact is that your average annual return or your IRR in crypto is probably not going to be that great.
As much these days.
No Super Bowl commercials for it.
No Super Bowl commercials.
Yeah.
And even I'm looking at the Bitcoin value today. Even when we did invest in crypto, we weren't really investing in crypto.
Yeah.
We were investing in the mining hardware because Nick was a technologist. So we knew if we bought these pieces of equipment, even if Bitcoin, didn't produce for us, we could sell those pieces on, eBay or Craigslist or, just on the used market. And so that was our,
that's exactly what happened.
That's exactly what happened. That was sort of our, our plan B. And that's what happened. And that was really when we just said, we know real estate so well. We know real estate like the back of our hand. It doesn't have these wild swings. Let's just, stick with real estate. So that was, our own trajectory there. So Sam and Sally, Sam took a 1-week course on crypto investing. He spent countless hours researching it. You can just feel him, just going up
the peak of Mount
Stupid as fast as he can.
Back.
He's researched the latest hot token. He is certain that he's going to make a 10,000 to 1 bet on whatever the latest coin is out there. Sally doesn't know anything about alternative assets like art, derivatives, crypto. You can see like Sally here, she just like enjoys going to the art museum, going to the theater, going to look at other people's collections of stamps or whatever it is. She doesn't know anyone that knows them really well, so she doesn't invest in them. Right. Let's talk about public versus private equities.
Got a couple more slides left here, and
not many.
These are kind of the two biggies. These are the two heaviest hitters, I would say, of all the slides we've looked at in terms of the different places you can put your money. So public equities are theoretically lower risk because they're audited. You have to do all sorts of SEC filings.
So again, public equities, you can think in your mind stock market.
Yes. Yep. So you're a publicly traded, SEC registered investment opportunity. You know, buying shares in Coca-Cola or something like that. They are pretty volatile because they're so liquid. So people can buy them and sell them, and stock prices can crash. You can have flash crashes and meme stocks and that sort of thing, where the trading activity and the pricing really has nothing to do with the fundamentals. The liquidity is a nice advantage of public equities over private equities. Public equities do not require that you are an accredited investor. So typically, to invest in a private equity, you often need to be an accredited investor, minimum 1 million net worth. That is a barrier. You might need to start in public equities and then kind of graduate to private equities. And then this is a really critical concept to understand here. Private equities often produce the highest return. They on average can produce about double the return of public equities. That's just how it works, and it makes sense, right? Because there's so much more liquidity, so many more investors that are able to invest in public equities versus private equities. So it's a supply and demand thing. So someone in public equities, they're okay with a 7% return, but in private equities, you really need to hit like a 10 or 12 or even 15% return to kind of be interesting in the private equity space. You just have to hit a higher return in that private equity space. Critically, the public equities are where most of the middle class put their money, but private equities are where the wealthy put most of their money. And this is something that, as we have, personally kind of moved up the class ladder that we've observed. I remember the first time we met someone that had invested in a private equity, and I was like, well, what's a private equity? I didn't even know that was a thing. I thought the stock market was all there was. And then, we know people now where they have, hundreds of millions of dollars deployed in various private equities, and they have little to nothing in public equities because those private equities, they generate a higher return. And that's the fact of the matter. If you have the ability to invest in private equities, you are almost always going to get a higher return than you will with public equities. So if you don't need the liquidity of a public equity, there's few circumstances where you are better off to put that money in a public equity.
I think from a behavioral perspective, one of the big differences between public and private equities is, we all know that in public equities, the CEO is chasing quarterly returns. They have to report to the board, they have to report to shareholders. And so it forces them they are incentivized to make short-term decisions so that they can have a great quarter and a next great quarter, instead of making, longer-term decisions. Even a 1-year decision is often considered to be extraordinarily long-term in public equities. And in private equities, there just isn't that pressure, and that allows private equity operators to have a longer time horizon. And in general, with almost any investment, the longer you have to work with it, to improve the value, to decrease expenses, to just enjoy the value creation that comes with time, the better you will do. And so I think that's a big part of the reason why public and private equities have diverged, especially over the last, say, decade or so. There's just so much news available out there. Imagine like, say, 1990, like the Wall Street Journal came out every day, but that was it. It was a daily report. And now it's like an up to the minute report of what CEOs are doing, what the boards are directing CEOs to do. And that just really warps human behavior in the public equities. I was looking over at, if you just spend a little bit of time Googling, like, where are the wealthy investing their money, you'll see that private equities comes up over and over and over again. I didn't find one, right away that I, vetted an article there that I could share in the group. But I think it's an important concept to lean into if you are an accredited investor, to really be thinking about what is the allocation that you want between public and private equities, and from a behavioral perspective, why it is that private equities are likely to generate more yield.
So if you do invest in public equities, there's a few simple guidelines, and this isn't our advice. We don't have any recommendations here. Just these are some words of wisdom we've seen from other people that we certainly
This is
adhere to
Warren's
personally.
advice.
This is Warren's advice. You can't outsmart the market. Like lots of hedge fund managers try, and yet all the studies show that the low overhead index funds typically outperform even the most sophisticated hedge fund managers. The ARK fund, is down 60% last year or something at one point. These really high flying hedge fund managers, they almost always crash at some point or another. Don't try to time the market. It's time in the market, not timing the market. So if you just do, it's called dollar cost averaging. If you just put a little bit of money into the market, each paycheck or each month or whatever, and you just stay in the market and you set it and forget it, you tend to have the best returns. That's just the mathematics behind it. So Warren Buffett, his guidance to his wife is if he were to pass away and she was to suddenly have the largest pool of liquidity in the world at her disposal. Warren says his wife should just put it into a low overhead index fund for the S&P 500, which is kind of insane, right? So he's like the smartest stock picker, so to speak, in the history of capitalism, but he is vividly aware of the fact that most people can't do that. And most people, 99% of people, are better off just kind of putting their money into a very simple, boring index fund. And another one is that no one has ever come out ahead betting against the USA. So I don't know. I certainly think of myself as a patriot, not in the political sense of the word, but just in the spiritual sense of the word. Like, we live in the greatest country in the history of the world by most metrics, and there has never been a time frame where over the long term you have really ever come out ahead investing abroad versus investing in companies, in stocks, in public equities that are based in the United States. You can get really high growth rates in other markets, in other countries, but eventually there's a kind of a crash event that's very head spinning and wipes out all of those really attractive gains. So how are Sam and Sally doing?
So Sam day trades stocks with excess investment capital when it is between investments. He's heard there are huge growth opportunities overseas, and he's always looking for the next hot country, the next hot stock, just really trying to make a lot of quick moves.
I heard Singapore is doing really well right now. I don't know.
Sally has heard that you can get higher returns in private equities, so she doesn't put much money in the stock market. What little she does invest in the stock market, she parks it in a low overhead S&P 500 index fund and basically just forgets about it. She checks it once a quarter, once a year, looks at her balance sheet. One thing we didn't say about Sally is immune to the behavioral fluctuations of humans. Yeah. She stays in the market. She doesn't freak out and pull out when everyone else does. There are like a few days in the last several decades in public equities where most of the gains have come from. And if someone freaks out and pulls their money out and they miss one of those days, which they're likely to do because those gains often come like right at the time that fear is just letting up, but fear hasn't actually let up yet. If you take out those days, you basically take out almost all of the return in public equities. So Sally is immune to that. She has the money in
doing
her
yoga
account, and yeah, she is. She's stretching her legs there. She's at the ballet on the other.
What pose is that? Is that a yoga pose there?
I'm sure our children know the name of the pose, but I don't. Yeah. So that's Sally and Sam. Let's talk about private equities. Next month, we'll go deeper into private equities and deeper into real estate. There's a concept of the jockey versus the horse in private equity. Yeah.
So in that kind of affectionate metaphor, let's say you're betting at the racetrack, at the horse racetrack. Amateur racetrack bettors, they bet on the horse. So they look at what horse has the most fun name, and horses always have kind of silly names to generate attention. They'll go try to look at the physical characteristics of the horse. I don't know. I've ridden horses before, but I don't know a damn thing about horses. I don't. You try to size up the animal. Okay, this one looks like the winner. That one looks hungry. Oh, that one peed on the ground or pooped while I was looking at it. I'm not going to bet on that one. And you try to come up with some idea of what's the best horse to bet on. The sophisticated racetrack bettors, they bet on the jockey because they know those jockeys, they're hanging out in the stables all day, every day, and they know more about those horses than any person, even a person hanging out at the racetrack all the time could ever know. They talk to the other jockeys, and all the jockeys know what's going on. And if you find a winning jockey, that winning jockey, they're going to find a winning horse. They want to win just as bad as the horse does, and they make or break your outcome. And the metaphor with private equity investing is people often invest for like a particular asset class. Like let's say you're investing in a real estate syndication. hey, I really like this apartment building. It's in a location that I like, or I like the look of the exterior facades. It's a nice modern paint scheme that appeals to my design aesthetic or whatever. And novice investors in the private equity space, they'll bet on the horse, they'll bet on the asset. Expert private equity investors, they bet on the jockey every time. They don't really care about the horse at all because they know that jockey knows more about the horse, that real estate syndicator knows more about those apartment buildings than the investor could ever possibly know, because they're living and breathing this stuff and talking to the other general partners. And so if they find a really good jockey and they bet on that jockey, they're going to do extraordinarily well perennially. How do private equities work? Basically, you put your money into what's called a blind pool. It's a bucket. It's not that fancy. I think sometimes private equity fund managers try to get really sophisticated and have these sophisticated schemes and stuff, but it's just a bunch of people putting their money into a bucket, and then that fund manager goes and deploys that capital, and then they get a percentage of the profit. So most private equity fund managers, they get a split of 2 and 20, or a 2% asset management fee and a 20% carry or carried interest. So 20% of the profit. And then they'll go deploy capital with other, talking about real estate syndicators, they go deploy that capital with real estate syndicators who then have their own levels of fees and splits and everything like that. At the end of the day, the investor doesn't care about all those things. They just care about kind of what's my return, and being able to deploy that capital in a way that they trust they're not going to lose their money, and they're going to get a pretty good return in a purely passive way. That's all a private equity fund is. It's nothing terribly complex. So what are Sam and Sally up to here?
Go ahead.
Oh, Sam doesn't understand why anyone would invest in a private equity. Why would you pay someone else to do something you can do better yourself and for free? You don't have to pay yourself any fees or splits or anything like that. Sally, she's a physician, and she knows, she knows all about the Dunning-Kruger spectrum, and she knows that being specialized in something can result in huge differences in outcome. So if a fund manager creates results that exceed the compensation they collect, she's happy to pay them. That's really what it comes down to. So if a skilled syndicator can get, a better interest rate on a loan, a better purchase price on an apartment building, you're probably way better off paying them fees or splits or whatever their kind of compensation scheme is, as long as you come out ahead on the difference. If they can double the performance of that asset and they take, half of the profit or whatever on that difference, you're almost certainly coming out ahead, and you do it passively. You don't have to be out there underwriting apartment buildings and managing property managers. It's a passive investment for you.
I think about the study that was done with surgeons, and I wish I knew the study title or something so that I could actually cite it. But basically they looked at novice surgeons and experienced surgeons doing laparoscopic removal of the appendix. And, there's a few incisions on the abdomen, they're putting the tools in, and a novice surgeon can do it. But they're moving things around, they're moving the bowels around, they're kind of poking through things. There's a higher likelihood of risk, of bleeding, of adhesions that come from moving all that tissue around. And an experienced surgeon just goes in, they know exactly where to go. They make far fewer maneuvers with their hands. That's what the study was looking at, is how many hand maneuvers do these surgeons make. And as a surgeon becomes more and more experienced, they do fewer things with their hands because they know precisely what they're doing. And then the patient outcomes are much better. That's exactly what this slide reminds me of, is they're both surgeons and they're both good. But Sam thinks he's a surgeon because he's been in the room when one appendix was removed, and Sally knows she's a surgeon because she herself has removed thousands of them.
That's right. Yeah.
All right. And then let's talk about real estate. Just a little teaser for next month.
This is our last slide of Passive Investing 101.
Yeah.
And coming up next is Passive Investing 201.
Yeah. So most wealth in the United States is accumulated in real estate. Said another way, more millionaires are made through investing in real estate than any other asset class. That includes both the wealth that comes for most families from owning a personal home. That's why it's so important in terms of social equality and other things to get people into personal homes so that their families can build wealth over time. And then also obviously through intentional investing in real estate. The middle class, even though the middle class places most of their investment capital in public equities, so that's things like, taking a certain percentage of their paycheck into a 401k, into a 529 for their children, all of those various investment vehicles are in public equities. They often end up with more wealth just in their personal home. That's certainly what we see. So we keep a balance sheet that we personally check every single month. We've been doing it since before we got married. And we look at our personal assets and then all of our real estate assets. And we really separate those out because we're running a real estate company, and then we have our personal assets. And if we took off all of our real estate investments, it's like 90% of our personal wealth is in our personal home. And then obviously, we have wealth from our real estate investments. But if we had never made the choice to invest in real estate all those years ago, it would probably be more like maybe 75% would be in our personal home because we would have put money into public equities.
The average household's about 70% of their net worth is accumulated in their personal home.
Yeah. And so if you can just, place some capital in real estate intentionally, then you get more into this bucket. And we know that more millionaires are made through real estate investing than any other asset class, and that most wealth in the United States is accumulated through real estate. So next month, so kind of our concluding sentence here, don't want to miss that. So we're kind of, painting this picture that behavioral economics shows that wealthy people tend to place their money in private equities. Private equities tend to perform better than public equities. We talked about the behavioral reasons why that happens. More wealth is created from real estate than almost any other asset class combined. So if you put those two things together, if you want to generate passive wealth in real estate and private equity, you've got the private equity piece, you've got the real estate piece, together, there's some superpower there. And I think a lot of people are figuring that out. And that's why there's been such a movement toward US-based real estate over the last several years, because people want to grow their wealth faster than putting it into a 401k that they can't access until their retirement age. And they have some sense of, I don't want to wait for retirement age. I want that freedom today. And I don't want just, 7 or 8% longitudinally over decades. I want to really ramp up my rate of return. Let's get into private equities. Let's get into real estate. So next month, we have this version of this presentation, but specifically diving into passive investing in real estate. What are the definitions that you need to know? What are the behaviors that we've seen from investors that have led to tremendous pain, the behaviors that we've seen that have led to tremendous success, and then most importantly, understanding how to really assess a syndication or a fund opportunity so that you can potentially make an investment decision.
Yeah, we're excited to share that with you. Hope this has been a event.
We're both super thirsty. We must have had salty dinner or something.
Yeah. We hope this is a good base layer of understanding some basic concepts, just a really high level understanding of the different ways you can invest passively. We do a ton of calls with people, and we feel like there's a lot of people who are missing some of these core concepts. So we hope you found this really valuable, and kind of lays the foundation for next month when we talk about investing in real estate. So
any questions? We're wrapping up. Usually we go about 2 hours, so we're wrapping up a little bit early tonight. Happy to entertain any questions that are either put into chat, or if anyone would like to unmute themselves. I just gave permission for that. Thank you for the comments there that this has been valuable. This is very different than what we've presented in the past. So glad to hear that this has been well received.
There's a question when we're talking about equity multiple and how IRR and equity multiple can kind of be like opposing metrics. And I would say equity multiple is just if you put in $100,000 into an opportunity and you got $100,000 back out, you double your money, so you'd have like a 2x equity multiple. That's the equity multiple statistic. And it's a critical statistic to look at, because the bigger your equity multiple, I would argue that's probably more important than your IRR. And if you look at something like average annual return or IRR in conjunction with equity multiple, that'll give you a really good picture of what the actual performance has been like just with those two metrics. We really like payback period, because it kind of combines both those concepts, right? In order to get all of your money back out, you've probably doubled your money, and you've done it in a certain amount of time. So we really love payback period. We would have put that in there, but we're trying to keep that list of metrics really short. So if you can hit a 3 or 5 year payback period and stay in that investment forever, you're going to be in really good shape, both on an IRR basis and an equity multiple basis.
Yeah, when we started investing, we had to look at payback period because Nick was working. I was in medical school. We only had one income. We were preparing for a child. We didn't have a lot of discretionary income that we could pull off to investing. So we had a bucket of money that we wanted to invest in real estate. And we didn't just want to put that bucket into real estate and then wait, 5 more years, 10 more years to be able to do the next thing. And so we had to ask ourselves, how do we get this bucket of money back as quickly as we can, keeping the property, and then do the next thing? And that's the basis of all of the wealth that we've ever created. And then we've found that that's a really powerful way to generate wealth when you can take one bucket of money and get many different investments from it. And then even now, working with higher income earners, we found that as income goes up, often, so does costs of schooling or housing or, taking care of parents, all of those things. So, people in general are maybe not able to generate a whole new bucket over and over, but they want to continue to generate yield. And so payback period has always been our number one metric. It's not the most popular metric, which is why we didn't include it as one of the main definitions. We really wanted to stick to the definitions that are kind of universally applicable to everything. But the closest would be annualized rate of return. So if someone can hit at least a 25% annualized rate of return, they can get their money out in 4 years or less. That has always been like the number one metric for us. When we are looking at a real estate investment, that's the number one thing that we hone in on. If the investment meets that criteria, then we look further.
Yeah. There's a question here. Why do you say gold bonds are not good? So I don't know if I said gold bonds, and also I just want to make clear we don't have any recommendations. We're not recommending or telling you to do anything. These are just some of our own opinions or observations or things that we do. So with precious metals, with gold, they have some pretty critical advantages. So they're very fungible. You can get silver and gold equal coins that you can carry in your pocket. You can carry a very significant amount of physical wealth in your pocket. They have kind of intrinsic value, and you can transfer that wealth very easily. You can just say, "Yep, here you go." When you have them in some sort of derivative, so let's say you have an index fund or some sort of bond that's backed by gold that maybe has leverage behind it or something like that, you lose a lot of those advantages. So suddenly you're just subject to like the whims of the market. Those vehicles, they tend to kind of go up and down in value along with the market, whereas gold, it's kind of that steady eddy, being a little bit counter-cyclical. That's kind of its big advantage. And then let's say worst comes to worst, gold is by definition kind of like bankruptcy proof and tax proof. And there have been times when the U.S. government has basically made it illegal to possess a certain amount of gold, in which case your ownership stake in that gold index fund is suddenly a pretty shaky looking investment. Like gold doesn't generate a lot of yield, so really the only reason you have gold is it's sort of for fun because you like it and just to have it in case of a rainy day. And if you have a gold derivative, if it's not in your physical possession, like if it's in a bank lockbox, for example, and the U.S. government was to say, "Sorry guys, you can't keep your gold. We really need that gold to fund this war," that has happened before. The bank's not going to let you take that gold out of the bank. So you need to have that gold in your physical possession. You don't want to have any gold derivatives. We've talked a lot about gold for some reason. So I feel like
you feel like Robert.
Yeah, Robert Kiyosaki's big on gold. We're not huge on gold or anything like that, but it's good to have for.
Oh my gosh, we can't have gold in our house. Our children would lose it.
We do not have gold because we know our children would lose the gold. Like they would be obsessed with it and they would like crack the safe and
not happening.
Yeah.
The thing that I think about, as Nick's talking there, is each individual asset class kind of has its own behavior.
Mm-hmm.
And then sophisticated players have come in and said, well, let's kind of blend this asset class with this asset class and kind of blend these ideas together to get sort of the best of all worlds into this one thing. But then all of a sudden you have like all these levers and you really want to have very discrete levers. So gold is a hard asset that's backed by inflation that doesn't have yield. It kind of has like one lever. But when you mix it with all these other things, then you have all these different levers. And so you lose the behavioral economics there of, say, gold, because you're mixing it all together. And I think that's really something to think about, is that it's like food, right? Like a great chili is great. And that's like good for like one thing. It's like a warm bowl of chili on a winter day. Like wedding soup is very good. That's like a lighter, you maybe want that in the summer. It's more broth based, but like you mix the two of them together and it's garbage. That's what happens when you mix together these sophisticated investment opportunities. You lose the benefits of all of them in exchange for the sophistication that sounds like it's a good thing, but typically isn't.
Yeah. Cryptocurrency is the exact same sort of thing. So if you own crypto, you almost certainly want to have like a hardware wallet with backup codes that you keep in a personal safe. Crypto is kind of interesting because so much money has poured into crypto now through derivatives, through index funds, that sort of thing, that cryptocurrency performance is now starting to mirror the performance of the stock market, because so much of crypto is now owned by Wall Street, which defeats the entire point of crypto, or the reason why crypto was originally created. And why bother having a an asset that matches the performance of the market when you can just invest in an index fund if you want to match the performance of the market.
Yep. Someone had a question. Can you further explain your strategy regarding cash reserves and lines of credit? Are you referring to personal lines of credit or asset-based like a HELOC? So in general, it's our belief that someone should have a year of cash or cash equivalents. It can be a little expensive to have just a year of straight liquidity. If you have a line of credit, then
this is all the money that you need to survive for an entire year, by the way.
Exactly.
So you need to analyze your burn rate. So we spend, let's say $10,000 per month. We need to keep $120,000 of cash or cash equivalents available.
Yep. So if we have a line of credit and that line of credit is say 120,000 and we have it at zero, then we're not paying any interest on it, but it's there if we need it. The opposite of that is we have say the 120 sitting in the bank, but it's not getting any yield. It's likely actually decreasing in value as inflation erodes it. And then it's likely that we're paying interest on that somewhere. Even, setting aside real estate investing, maybe we just have our personal mortgage. We're paying interest on our personal mortgage that we wouldn't pay if we had paid down the personal mortgage by say that 120,000 and then had a HELOC on the home that we could access. So those are kind of the two extremes. The benefit of cash is it's yours. If it's in an FDIC insured bank account, you have every reason to believe that you can access that cash. It won't be frozen or anything like that. A HELOC is technically yours, but banks have been known to be skittish and they've been known to freeze accounts, to lower credit limits suddenly without any advanced warning, either because of new information in your personal situation. Maybe you fall and have a very serious injury and the bank finds out that you now have a disability and that you don't have an income. And so they drastically lower your line of credit at the time that you need it the most. Or there's something systemic like 2008 when, banks and credit cards were just shutting down opportunities to get credit left and right. So those are the kind of the risk extremes. So if you have 50-50, that's the number that allows us to sleep well at night, is knowing that we have 50% of our cash reserves in just pure cash and 50% available in a line of credit. And then however you get that is fine. I would say it matters more the bank and the behavior of the bank. Is this a steady Eddie bank that's not known to lower lines of credit or to freeze lines of credit? Or is this a skittish bank that looks at things a lot and reassesses things a lot and could potentially freeze your lines of credit? That's more important than if it's, personal or if it's backed by an investment property or something like that. Knowing the behavior of your bank is critical when you're playing at this level. Not all banks are the same. They are run by boards of directors that have, personal biases and influences and understandings of economics. And that board of directors determines how that bank is operated. And that's really critical when you're thinking about your emergency life savings.
Yeah. Excellent questions. Keep them going. We love answering these questions. I have another question here. Have you deployed all the cash in your current fund? When do you anticipate opening the next fund? Will it have a similar strategy? So we've used the same business model for going on 15 years now. It's a BRRRR business model. We did that before there was the word BRRRR. And so we'll buy a property, rehab it, rent it, and then repeat that. Do a cash out refi to return capital to our investors and do it all over again. So we anticipate we'll use the exact same strategy for our future fund. We have about 15 million in cash between Fund 1 and Fund 2. We're going to deploy about half of that here in the next 30 or 45 days in residence at Discovery Square. We've got a couple other opportunities we're looking at after that, as well as doing a return of capital to our investors in Fund 1 once we've closed on RDS. So that's kind of our near-term outlook on Fund 1 and Fund 2. And when will the next one be open? Hopefully sometime later this year. So right now our big focus is on deploying the capital that we have, really aggressively stewarding that capital. We're about to go into the busy season here, so we're going to be really leaning into our day-to-day operations and just squeezing every bit of efficiency we can out of all the assets we've acquired here in the last year. But I'm guessing we'll have something available here in the not so distant future.
I'd say probably summer. BlackSwanFund3.com if you want to get on the wait list.
Yeah. There was a question there. I'm new to Black Swan, hoping to invest in the future Fund 3. Will you be able to provide an overview on a 100K investment over this meeting, or should I wait and have the discussion one-on-one call? Glad you asked that question. So anyone here can go to meetblackswan.com. They go to meetblackswan.com. They go to this lovely website. It has a little video of our team here. So you can get on the Fund 3 waitlist via this link. And then there's this How It Works infographic. So there's a few different ways we kind of present the exact same information, and we happen to have an example of you investing $100,000. You place some capital, cash flow distributions start in year 2. You might get $5,000 per year via quarterly distributions. In years 3 to 4, cash out refi occurs on the stabilized properties. You receive a full return of capital. You've now you stay in the deal forever and have those infinite returns. That's kind of when things get really magical. And then you might receive cash flow distributions of $10K per year quarterly, and 10K per year, via quarterly distributions. And then every few years, we're going to have really big distributions, maybe 30 to 50,000 via cash out refis. So and then after 20 years, we're going to sell, and you might get, say, $600,000 20 years from now when that fund liquidates. So this is just for representation, hypothetical purposes. These are not promised returns in any way, shape, or form, just to give you an idea of the overall pattern.
That's based off of, the last decade plus, all of the deals that we've done. This is the pattern that we look for over and over and over. So, as I mentioned, we look for a total annualized rate of return of 25% or higher through cash flow and forced appreciation. If we're able to make that happen, then we can hit that 4-year return of capital. So we add an extra buffer in there and we say 5 years or less. In many of our deals, we've been able to do it in 2 or 3 years because we tend to have pretty conservative underwriting. So we're able to exceed our projections, but that's the model that we look for over and over and over. It's the basis of every deal we've ever done. And so we've taken those historical returns and projected them out for the behavior that Fund 1 will follow, Fund 2 will follow, and then future funds. Again, just all projections, but based on the last decade of experience.
Are you still seeing the same quality and volume of opportunities now versus 5 years ago? No. So I actually saw some stats today. So in terms of on-market multifamily properties, I just happened to see this particular stat. There's about 80% fewer listed properties than there were a few years ago at this time, and about 90 to 95% fewer publicly listed properties versus last year. Last year was a very frothy year with sky-high valuations and tons of transactions taking place. Ironically, we didn't close on a single deal of size in the first 3 quarters of 2022 because prices were just so high. And we knew that those prices were going to come back to earth when interest rates went up. And then we've closed on 6 deals. We're about to close on our 7th deal in Q4 of 2022. So when prices crashed, we were buying assets at kind of rock bottom prices. There's 2 assets where we paid the same price the seller had paid in 2017. And I don't know about you, but I think real estate values have gone up since 2017. So I think we did pretty well on those. So we were able to secure quite a few acquisitions during that time frame. And we're still very aggressively reaching out to sellers, looking for sellers that need to sell. Maybe they got a variable rate loan in 2021. That loan is maturing or is tripled in or quadrupled in the debt service that they have to pay each month. And they need to sell, and that's why we're waiting there with $15 million in cash to buy when that opportunity strikes. So we're really excited about the acquisition opportunities that we're getting in Fund 2 right now, and I'm really excited about where that fund's going to be here in 5 years.
We're very well positioned because we have never failed to close. We have never gotten an asset under contract that we have failed to close. That's pretty rare in the industry. I would say, I don't know what the average close rate is, so don't quote me on this, but I might guess maybe 60 or 70%. And so now
last year, probably lower than that.
Yeah. So now that's a really important metric.
Yep.
It's like the number one thing that brokers are looking for is certainty to close. And we've never failed to close. And so we have a reputation for being known as closers. And so we just continue to, make phone calls, pound the pavement, have lunch. Nick and I have been out to more lunches than you can possibly. 3 lunches, 11 a.m. lunch, a noon lunch, and a 1 p.m. lunch.
We've had triple headers.
Talking to brokers, bankers, owners, just everything we can to drum up deals.
Yeah.
Hannah asked, historically, how quickly are you returning the first 50% of invested funds if full return was at year 2 or 3? That's not a metric that we really look at because with a cash out refi model, you get almost all of your return all at once.
Yeah.
So it's there's a little bit that comes through from cash flow, but the real magic is when that cash out refi happens. So it's not like 50% comes and then later another 50% comes just by the mechanism of your cash out refi. It's a few drips, boom, all of it's back.
Yeah.
Good questions.
Lots of great questions there.
Anything else as we wrap up here? I think we've hit every question. So we'll give another few seconds here for anyone to drop a last minute question in.
Way back when, Stacy Smith talking about that risk adjusted return on option number 4. Technically, if you invested $10,000 in number 4 3 times, or I'm sorry, invested in it 4 times, you would make $30,000 on that $40,000. That's exactly right. Option number 4 was far and away the highest return opportunity. So if you can find a way to hedge that risk, probably don't want to go all in on option number 4. That would be a recipe for disaster. But if you can find a way to hedge that risk to diversify, but have a large allocation to opportunity number 4, you're probably going to do super well in the long term. So it's all about your risk appetite or whatever works for you. That's a great observation. So you would triple your money in that time frame, and then potentially lose it all. So you have to
lose it all, triple lose it all.
So you have to hedge that bet.
I'm too old for that.
Yeah.
Excellent questions tonight. Thank you guys so much for your attendance. We love pouring into you. We hope this is valuable. We have a feedback link that we've been sending out. So we'll put that into the email. We love your feedback. It's super valuable for helping us to curate our presentations, get the type of content that you want out, whatever it is. We want to make sure this is a really high value use of your time. We appreciate your attendance and your participation, your questions. We will see you again next month to dive specifically into real estate passive investing. Super excited about that. Until then, stay in touch in our Facebook group, Real Estate at Scale, via our newsletter that goes out every Tuesday. If there's anything we can do to serve you, just please let us know. Otherwise, have a good night.
Bye.
Thanks, everyone.